This is Taking Stock on Bloomberg. I'm Pimm Fox. President Obama, he's in Las Vegas today. He just detailed his administration's latest plan in order to help the housing market. New financing rules under the Home Affordable Refinance Program, or HARP, designed to create some movement in the housing market. My guest, Gary Shilling, economist. He's been with me through the hour. Doug Dachille, co-founder, chief executive, First Principles Capital Management. And in Washington, D.C., Bloomberg senior economic analyst Nela Richardson. Nela was formerly a senior economist at Freddie Mac. Good to have you all with us. Doug, I want to come to you and talk about this latest plan in order to reinvigorate the housing market. This is like Yogi Berra, right? Deja vu all over again. We've been here before. What's going on with this plan?
Actually, this time there may be some positive benefits out of this one. First, I like to look at how did the market react. Okay, and if you look at what the market did, the market is actually thinking that there's going to be some significant increase in refinancing. Because today, when you look at what happened to the prices of mortgages that should be the bellwether to see how well this program is going to work in terms of helping borrowers. Because if borrowers are going to be able to refi, who is going to take the brunt of that? Investors. So what you have to do is look today at what happened to the prices of mortgage-backed.
So what do investors do?
Well, investors started selling premium mortgages. Right. Mortgages with coupons of 6 and 6.5%, for example, today, they went down by 1% in dollar price today. So, I've been saying that one of the biggest signs of failed policy is not the fact that you've gotten the rate on the mortgage low. It's just look at the dollar price. Because all that happened when we lowered mortgage rates was we sent dollar prices of mortgages to unprecedented highs, which meant that the only people that were benefiting from Fed buying activity was mortgage-backed securities investors and not homeowners. Today, for the first time, we actually saw some potential transfer of that wealth to borrowers away from mortgage-backed securities investors.
Nela, come in on the topic of this new plan by the administration to help the housing market. What's the sense in Washington that this will actually pass, or indeed whether it will do anything?
Well, Pimm, I actually do agree with Doug wholeheartedly that it begins and ends with the market reaction. However, I'm looking at a different market than the investor market. I'm looking at the housing market. The way to judge any policy coming out of Washington is, does it or does it not increase homeowner demand, the demand for homes? Right now, we are so out of equilibrium. We have inventories, supplies of homes, foreclosed homes on the market today. The only thing that's going to cause a reversal in our housing trajectory is to rebalance, get market equilibrium back, have supply equal demand, and get potential homeowners who've been waiting on the sidelines for the bottom to come back into their homes. Now, the president's plan, it may have benefit for homeowners who are underwater, who are in good standing, but does it move that needle? Does it move that trajectory towards more demand in the housing market? And that's the question that I have for this program.
Doug Dachille,
well, I mean, there's only so much you can do. I mean, let's be honest. And we had 70% home ownership in the United States of America at the time in 2008. So, I mean, the fact that we overbuilt and we built well beyond the amount of houses that people could be affording, the only way we can do that is high FICO immigration. I mean, we need to bring more people in. We're certainly not going to produce them inherently by, with having new births. I mean, the only thing you can do is immigration, divorce, and kicking your kid who just graduated from college out of your house and having him buy a new house. So
but those kids now are staying home. If you look at home ownership of people under 30 versus those living at home, they're moving in opposite directions.
Right, household formation, right?
But there's no legislation.
Mom's cooking is fine, and she does the laundry.
Right, but there's no actions that you're going to take to be able to change in a short horizon. That's a long-term issue.
Well, our estimates are that at current new construction and at current formulation of new households, and to form a household, you got one or more people have to move into a separate dwelling unit. You got to either want to own or rent a house. But we estimate at current rates the 2 to 2.5 million extra inventories over and above normal working levels that we think are out there will take 5 or 6 years to work off.
5 or 6 years.
Yeah, 5 or 6 years. That's just looking at the current numbers. And at that time, and in that time, I think we probably will see house prices return to equilibrium, and that would take a decline of about 20% from here for a median single-family house price to come back to the equilibrium that has been established since 1890, if you look at Bob Shiller's numbers.
20% decline from here, Doug Dachille.
But there's no mortgage plan that's going to solve that.
Right.
So you have to look at what we're trying to do. I mean, those problems can't be solved. What we're trying to do is make sure that people who have been paying, but have been paying an above-market rate, will actually be able to get the market rate and be able to continue to pay, so that house doesn't get, which is underwater, and a borrower has been responsible and kept paying. We don't want that borrower to just drop the keys off at the bank and not pay anymore.
You know, you've got a good point, because this program really isn't going to help housing. It is going to basically transfer money from people who own mortgage securities to homeowners who are still making payments.
Right.
It's an income plan. It's not.
Right.
It's not a housing
plan. It's designed to actually transmit all of the economic benefits of monetary policy to some borrowers. That's real, because right now monetary policy, all of the buying by the Federal Reserve, did not translate those benefits to consumers and borrowers. It translated them to mortgage-backed securities investors.
And by the administration to help people refinance their mortgages. What about the losers? What about what happens to the existing mortgages? People have been trying to get as much yield as possible for their portfolios. Now it looks as though the government's not going to help them.
Right. Well, the interesting thing about this plan is that it brings together some key groups that haven't always played well in the sandbox together. That is the GSEs, with mortgage lenders and mortgage insurers, to create this program that helps people who are already in good standing refinance their mortgages. The effect of this will be to increase the prepayment rates on Freddie and Fannie mortgage-backed securities going forward. So people who are already invested in these securities will see an increase in their payment rates and maybe a change in their yields going forward, and that could be a concern. But let's go back to what this program actually does. It makes it cheaper for pre-existing homeowners to refinance their mortgages, but it does a second thing that points to that market impact that I talked about earlier. It forgives, in some sense, the representations and warrants that the servicers have to make on these loans to Freddie and Fannie. You know, banks have stayed away from Freddie and Fannie loan refinances because they didn't want to be held responsible if they refinanced a loan and then 6 months down the road, the homeowner foreclosed for whatever reason. They would be responsible for that non-performing loan to Freddie and Fannie. Now, under the White House program, new banks that come in and refinance from original lenders would no longer be responsible if the homeowner ran into trouble down the line. This is the hope of the White House, is to encourage bank lending and encourage competition among multiple lenders that will drive down the cost of refinancing, and that component may have effect on mortgage markets overall.
Oh, absolutely. I mean, you know, everything is driven by incentives, right? And if you give the banking industry the incentive, and which will be there is no risk of putbacks of these loans if they subsequently default after a refi, if you relax that, you will get banks to be willing to refi because it's profitable business to do a refi. You get application fee. You can actually earn the price that you give the borrower is much different than the price that they can sell that loan in the market. So it's actually a very profitable business to originate loans, refinance them, as long as you're not going to take the risk of a putback, where the agencies will say, you know what, you didn't comply with the guidelines. We're going to put the loan back to you. It may not perform. You have to take that risk. The
government absorbs that risk.
The relaxation of this is going to...
It really puts the risk on Fannie and Freddie, which are wards of the government right now.
And that's the whole why we've been in this mess. It's the complexity of balancing the issues of the taxpayer concerns, which is preventing further losses at Fannie and Freddie, from the interests of borrowers and the interests of the banks. And so this actually has solved that problem, because they're not just giving a free pass. These people that they're going to do a refi have to show that they had a payment history of being timely on their payments. It's not that you're just giving a guy who's been delinquent a free pass and they're not going to put you back.
But you also have the problem of if there's a home equity loan or a second mortgage on here.
They address that.
And apparently they are being forced to go along with this as well. So it really is, it's another government bailout, directly or indirectly, it seems to me, because if anything goes wrong, as you say, the banks are off the hook now. It's Fannie, Freddie, and the federal government, the taxpayer.
We're going to have more with Doug Dachille, more with Plan Is Enacted. People who have lived in their homes before 2009 are current with their mortgage. Perhaps they're going to be able to take advantage of lower interest rates, move from a mortgage that's, 6.5%, 6%, down to maybe 4.5% or 4%. What's wrong with that? Leave out the investor for just a moment. wouldn't that benefit the overall economy? You get people that have more money in their pocket, they can spend it.
Oh, sure. It puts more money in their pockets, and in some sense, it rewards them for being current on a underwater mortgage in many cases. In other words, they're not strategic defaulters, as the term goes. They're not people who walk away from a mortgage that they can't afford simply because they say prices are declining. This is throwing good money after bad. So it's a reward for being for good citizenship, if you will, being fiscally responsible, and it does put more money in their pockets. Now, of course, you say, what are they going to do with that money? Are they going to save it? Are they going to spend it? Is it going to have a net effect on the economy in terms of spending, or are people going to do what a lot of people have been doing now, is just work down their other debts and increase their assets? But it's from that standpoint, sure, makes sense. You say we're setting aside the losers on this.
We're going to get to them in just a second. We got more.
Okay.
But Nela Richardson, come in on the topic, though, of principal reduction. If you don't actually cut the value of the home that has been mortgaged, isn't this just a short-term measure to help some homeowners if it doesn't actually reduce the overall debt load?
You know, principal reduction really gets at the heart of the problem, Pimm. Prices appreciated so much during the housing boom that we're still seeing those effects. We're still seeing price declines both nationally and regionally, even now. And so principal reduction is a major step forward in terms of getting homeowners, both those who are current and those who are on the precipice, those who are in danger of foreclosure, back and keeping them in their homes. And let's talk about these borrowers on the precipice of losing their homes. They actually will have a significant impact on our economy if they are allowed to actually go into foreclosure. That increased inventory that's pent up on bank balance sheets and maybe pent up on homeowner balance sheets going forward will slow down the pace of recovery. So while this program is terrific for those people who have been current on their homes, refinancing into better mortgage products, it doesn't solve the root of the problem, the fact that we have these house price declines, the fact that there are still people who are in trouble, who are in danger of losing their homes, and the effect of those foreclosed properties, both current and future, will continue to weigh down our economy.
Doug Dachille, I'll give you about 15 seconds. We're going to continue.
Okay, in 15 seconds, all I know is that if you were to do the same thing in your brokerage account in a stock on a margin loan basis, no one's giving you debt forgiveness. They're closing you out and they're foreclosing on your stocks. And no one was saying when people were borrowing money to buy stocks and stock market was going down, you know what, we should give principal benefit reduction on a margin loan. Instead, they just seized the assets, sold it into a down market, and closed out your account. So, I have a very different view on whether we should be allowing people to renegotiate who haven't paid the mortgage, maybe never could have even afforded it at time zero. I have a very different view on helping those as opposed to who is being helped today.
Gary Shilling, let's talk about the losers just a little bit more.
Okay.
Pension plans, insurance companies, individuals who are counting on the income from the purchase of mortgage securities, they're going to probably now see huge prepayments, right?
Well, that's right. Now, of course, people, if they read the fine print, they knew this was always possible, that they could be prepaid. This isn't as though there's been a breach in contract. But in effect, it's a legislated breach in the social contract, if you will, what these people thought. And, of course, we're in an environment now where income is very, very difficult to come by. I mean, you look at a money market fund and you maybe get a massive 1, 2, 3 basis points return on your investment.
That doesn't even pay for the stamps.
No, it really doesn't. I mean, a lot of these money market funds, of course, are waiving their fees, or otherwise they'd have negative returns. And you see this, and of course that has had some very adverse effects. And this could do the same thing, drives people into much riskier investments. You saw that drive into junk bonds, for example. They got hit when things sold off in August and September. But I think a lot of that was people just reaching for yield, lust for yield.
Nela Richardson, give you about 15 seconds here. Is this more of a political effort on the part of the president to just sort of go after a particular constituency because he knows his poll numbers are a little bit shaky?
I think it's more than that. I think that it's really about getting back to housing. After a year of other things, from the European debt crisis to banks, it's really about housing if we want the recovery to go forward. And in terms of mortgage refinances and these people on the precipice I talked about, we need smart solutions. We need to restructure incentives so that the government shares in the upside while helping homeowners deal with the downside going forward.
I got to thank you all very much. Nela Richardson from Washington, Gary Shilling, Doug Dachille. Thanks for taking stock. I'm Pimm